I'm joined today by Stephen Gray, Portfolio Manager of Eastspring Investments. Stephen is among the incredible investors sharing insights at the Equities Investment Forum today. Welcome, Stephen. It's great to have you with us.
Thank you very much. It's lovely to be here.
Stephen, does the disappointing performance of emerging markets over the last 10 years suggest it no longer is relevant for inclusion in pension fund mandates?
Well, I think emerging markets can never be irrelevant. I mean, with 84% of the population, 60% of GDP, and actually 70 to 80% of GDP growth every year, plus the fact that they make up 10% of global equity markets, means that they can never be completely irrelevant. But I would like to point out maybe two more considerations. So one is pricing. If you look at the last 15 years in which emerging markets have underperformed, it's all to do with derating. Actually, emerging market earnings as a percentage of global equity earnings has remained around 13 to 15%. So you've got this derating to the point where emerging markets are trading at a 35% discount to developed markets and a 45% discount to the US. So at some point, pricing becomes an issue, valuation becomes an issue. But the second point is diversification. During this period, there's a lot of concern that the US has become too dominant within the global markets. The US is 60% of the MSCI All-Country World Index, but only 26% of global GDP. Then you turn to the emerging markets. Technically, they are 10% of the benchmark, but funds are underweight. They're sitting with 5% exposure to emerging markets, but those same markets make up 14% of global earnings today. So I think the argument for diversification is even stronger now than it's ever been.
And still investors question what's changed that makes this a pivotal moment for EM.
I often face the argument that valuation alone isn't enough. And that's really been the argument as emerging markets get cheaper and cheaper every year the last 15 years. But I think there's a really interesting moment happening right now. And there's three drivers. The first one is dollar weakness. The dollars are really weakened, 10% this year, the trade-weighted dollar. But if you look historically, the dollar goes through very big cycles, and there's been 5 since 1975 in which the US dollar has either weakened or strengthened by at least 40%. So you could argue that we're just at the beginning of a cycle. And what's very interesting, there's an excellent correlation between emerging market outperformance relative to developed markets and US dollar weakness. There are many drivers, but a very simple one, for example, is that emerging markets have 13% exposure in revenue to the US market. Other developed markets have around 20%. And obviously within the US, 73% of earnings are earned within the US. So emerging markets are less vulnerable to dollar weakness. The second driver that I'd like to point out is that emerging market central banks are cutting policy rates. Now, historically, emerging markets have always outperformed developed markets when central banks are cutting policy rates, on the proviso that we're not in a global downturn. So fundamentally, when you look at emerging markets today, real policy rates are very high. There isn't a problem with inflation. And actually, when you look at government debt to GDP, if you take the top 10 emerging markets, on average, it's around 60%. For the developed markets, it's around 120. So they're sitting in a very strong position relative to developed markets. At the same time, dollar weakness gives us more space to central banks to cut rates. And then we do expect that the Fed is going to start cutting rates from this month. And historically, emerging markets have strongly outperformed developed markets following a Fed cut rate, again, as long as we're not in global recession, which isn't the best case. And then the final point I want to maybe just highlight, we can go into it, is that China has been a massive drag on emerging markets over the last 5 years. Okay. If you look at the dispersion, if you look at how well developed markets have performed relative to emerging markets, there's a very big gap. But if you take out the US, which is up 100% over the last 5 years, going into 2024, and you take out China, which is down 17% over the same period, the performance of emerging markets ex-China and developed markets ex-US has been pretty similar. So I think if going forward, as long as China isn't the same drag, it creates more space for emerging markets to perform.
To some extent, all three turning points are already in play, with EM outperforming DM year to date, helped by China's strong 23% performance to end July 2025. Why do you think the China market can continue to remain supportive of EM post the recent rally?
Look, I think China for me is a great example of value doesn't matter until it does. Because the performance year to date has really just driven by a re-rating. It hasn't actually been driven by earnings yet. Okay, but still to give some context, even though the China is up 25% in July, when you take the 5 years from June 2020 to 2025, China is completely flat, whereas the MSCI World Index is up 80%. So there's still a large catch-up to happen. And then, you think about China on a 12.5 times forward PE, it's still offering decent value. But I think you've also got to combine that with two other factors. One is liquidity. So far, the Chinese market, and in fact, emerging markets, have really been driven by local participation. But within China, that's really been institutional buying. The retail market has yet to come into the space. Chinese households sitting on $22 trillion worth of savings. They're not investing in the property market at the moment. With policy rates coming down, they're getting very little return on their deposits. So we do expect a fair amount of deposit migration into the equity market. At the same time, foreigners remain underweight. So long-only equity funds are still underweight China. And even within the emerging market space, there are many surveys. For example, HSBC did a survey recently that said even emerging market managers are around 3.5% underweight versus their benchmark. Okay, so you've still got liquidity that could still come to China. And then you've also got to ask yourself, fundamentally, is there a case? And I think when you look at it in this era of large instability and uncertainty, the fact that China remains committed to its 5% growth rate provides some sort of comfort. So China has a very calibrated policy response to support consumption in China. They've increased the budget deficit. They're issuing treasury and local government bonds. They have very focused subsidy programs, and they're cutting policy rates. And finally, I think it's quite important, when you speak to people on the ground in China, they will say to you, one of the more important indicators is this symposium that President Xi had with all the private sector heads in February this year, where the message was the era of heavy-handed intervention into the economy, into the private sector economy, is over. Now, you combine that with things like DeepSeek, which is reinvigorating the IT sector. You combine that with the fact that although property remains a drag, every year it becomes a lesser drag just because it becomes a smaller part of the economy. And then finally, you've got things like the anti-involution policy, which would hopefully improve returns for capital-intensive sectors in future. So I think there are legs to why China can remain strong. But my point is, it doesn't need to outperform. It just needs to stop being a drag for emerging markets to have a better chance of outperforming relative to developed markets.
This combination of turning points for EM combined with cheap valuation sounds interesting, but does it remain valid in the new world of tariffs?
Yeah, look, that's a very tricky question because the level, the timing, or even the legality of tariffs remains in question. There's no doubt that the tariffs are bad for global growth, but it affects everyone equally. And to some extent, emerging markets are less open than developed markets, so they are less impacted. But I think you should also look at what has been happening over the last 20 years because emerging markets have been increasingly decreasing their exposure to US. I'll give you two interesting perspectives. The one is that the emerging market to emerging market trade has increased dramatically. So over the last 20 years, EM to EM trade has increased from 25% of total exports to 50% of total exports. If you just look at China on its own, when the China-US tensions really started in 2018, since that period, China has reduced its dependence on US exports from 20% of exports to 14%. So I think what's going to happen, those trends are going to continue and probably increase. You just take the latest pretty uneasy meeting between the heads of India, Russia, and China as a demonstration that emerging market will find a response to diversify more away from the US and towards other emerging markets and towards other developed markets.
And if allocators were to become more interested in EM, what would you suggest is key for them to consider when increasing exposure?
Well, I obviously have my own personal biases on this, but I think they remain valid. I mean, the first one is that I would have some exposure to active. At the moment, there's been a net outflow on the active space from emerging markets, but there has been inflow on the ETF space. I think that should turn towards more active in future because emerging markets remain far more efficient than developed markets, and therefore the opportunities for alpha are much higher. I mean, some of the old arguments are emerging markets, are still underbrokered. They don't have as much research. There's still very big governance concerns, so you really need to do more fundamental research. But also emerging markets have far more local market participation and daily liquidity, which makes those markets far less developed. For example, in the US, retail is about 25% of daily liquidity. It's 80% in China. It's 70% in Korea, it's high 60s in Taiwan, etc. The other point I'd like to make is that when allocators look at emerging markets, I really think they should focus also on having some allocation to emerging market value. So if you look over the last 25 years, it's really been one big cycle. But as you look at that, when emerging markets were outperforming developed markets, emerging market value was outperforming emerging markets. And on the converse, in the last 15 years, as emerging markets have underperformed, emerging market value has underperformed. Now, I want to give a very interesting perspective. If you look at what happened in COVID, which is a bit of a mini cycle in the long down cycle of the last 15 years. When COVID first became a concern in 2020 and everybody panicked, money flew out of emerging markets. But the money that remained was really anchored on a few large, tends to be more high quality names that are thought to be defensive. So when that happens, the value dispersion within emerging markets radically grew. What that means is that the most expensive part of the market became even more expensive relative to the cheaper part. But conversely, in 2021, as the capital returned to emerging markets, it was emerging market value that dramatically outperformed within emerging markets. So I think, and currently right now, we're sitting at the same level of value dispersion that we saw during the bottom of COVID. So if emerging markets were to start outperforming relative to developed markets, I think the cheaper part of that, which is the emerging market value, could even outperform more.
Thank you, Stephen. We're going to need to leave it there and get back to the forum, but I really appreciate you sharing your expertise with us today and for being a part of Global Investment Institute's Equities Investment Forum.
And thank you for the time.